Back. Let's invite Ashutosh Bhargava, fund manager and head of equity research at Nippon India Mutual Fund, to talk about the way forward. Thank you very much, Ashutosh, for joining in. I know you're constructive on the Indian markets over the medium term, the cyclical India story. But how are you reading the near term? Because US interest rates are still very high. China's slowing down. The picture from the Q1 earnings season in India is showing the revenue is slowing down. Food inflation has been rising. So given all this, the cocktail of this, these news that I just spoke about, how are you feeling about the near term?
Hi. Definitely, there are, since we last spoke, macro has definitely worsened both in India as well as in key global markets like US and China. And most importantly, the monetary easing expectation, both in the US as well as in India, I think that has been challenged. Given this kind of backdrop, you would have expected markets to kind of show some kind of pullback, but on the contrary, markets in India and even abroad, I mean, they are climbing wall of worry. Indian market in particular is showing great resilience. Having said that, the environment from macro perspective is likely to remain challenging. In India also, you have food inflation as a challenge, and global challenge also remains. And here on, we don't see where the expectations of earnings are for FY24. In particular, there can be a solid case for any material earnings upgrade. So from here on, the markets could remain perhaps in a range-bound manner, and I don't see a solid reason for any strong up move from here on in the near term.
Okay. Ashutosh, so range-bound, yes. You don't see a reason for an up move, but is there a concern that there could be a down move? I mean, the question is basically, are there more risks than upside triggers, or are these two evenly balanced?
So, from India perspective, on the positive side, and to some extent globally, what we are witnessing in terms of macro challenges, they are not getting reflected in earning expectations. So even in the US or any other part of the world, this past earnings season, we saw earnings upgrade. So corporates in general remains to be in good shape. This interest rate hikes locally and globally is not affecting corporates in general. Pricing power remains strong, and that's what perhaps market is discerning between markets being more resilient in terms of performance versus the news flow that you are getting. So to my mind, the case is not for a very sharp correction. That's very difficult to forecast in this kind of environment. But at the same time, this is not a time where we would advise investor or in our portfolio, we would like to add incrementally more risk in general.
Ashutosh, what is the kind of earnings growth that you are penciling in from here on for all of FY24?
So broadly in line with consensus, so mid double-digit kind of earnings, and as we all are aware, first quarter has been a reasonably good earnings season. There itself, we saw 1.5% kind of EPS upgrade for the full FY24. And there also, if you look at the mix, it's mainly to do with select companies, and more particularly in terms of detail, it's more about the margins rather than any top line, upgrade. So margins for the next 2 quarters, to our mind, would continue to support earnings. And from there on, we will have to see how local and global demand would shape up. And there, our view remains that there could be some moderation, there could be some challenges which could emerge maybe after 3-6 months in terms of top line growth in general. So we'll have to see, in the second half or as we enter into the next calendar year, how that part would shape up.
Ashutosh, range-bound markets are also a great time to accumulate stocks. So can you tell us, in the last 1 month, which are the pockets where you've bought shares, any themes that you would like to highlight where you were comfortable with the valuations and you went ahead and put your money?
So we incrementally added some bit of defense to the portfolio in the form of more of a compounder. So as you perhaps would be aware that our approach for the last 2-3 years have been to be in sectors which are domestically geared, cyclical domestic sectors, rather than these long-term consumer compounders or exports. Here we think, part of this story has played out in valuation. So incrementally, we have added some bit of defense in the form of utility names, some FMCG names, some insurance names as such. And the idea here is that, we have to look to balance the portfolio for the event where if there is a bout of volatility, the portfolio is relatively less impacted.
Okay, Ashutosh, just one final question. I was going through your portfolios. Of course, you're very heavy on the financials. This margin compression that we are seeing, how much longer are you factoring this lasting? And do you think we are set for some downgrades coming through here?
I think in this particular sector, the worries to me particularly seems overblown. If you think about it, the basic premise of margin worries were related to the fact that RBI will cut interest rates, and most of the asset books of all the banks, particularly private sector banks, are repo linked. And here we are, where in the last 15-20 days, we have realized that RBI is not going to cut interest rates, perhaps till at least for the next 2-3 quarters. So that itself should kind of reduce the worries related to margins. And other than that, in first quarter itself, we have seen companies being more prudent. A lot of the margin hit has been taken. And where consensus expectation of earnings and NIMs are, I don't think there is much scope for negative surprise as far as margins are concerned, or overall profitability of banking or sector or lenders in particular is concerned.
Okay, all right, Ashutosh, it's been good speaking with you. Thank you very much for joining in and giving us your views on the market. Well, that's a word coming in from Nippon Mutual Fund. We'll take a quick break on that note. Come back on